Hi CA students, let's revise CA Final AFM Chapter 13 Business Valuation Practical Question 12. The following information is given for three companies that are identical except for their capital structure. Total invested capital, debt assets ratio is given, shares outstanding, and then pre-tax cost of debt, then cost of equity, then operating income, EBIT is given for orange, grape and apple. Now tax rate is uniform 35% in all cases. First requirement is to calculate the weighted average cost of capital for each company. So for weighted average cost of capital, the formula will be KO equal to KE multiplied by E by E plus D plus KD multiplied by D by E plus D, wherein KD is after tax cost of debt. Here we have cost of equity and we know the ratio of debt or assets, and KD is KD we have, but it is pre-tax, so we have to adjust the tax portion to arrive at this post-tax cost of debt. Then debt ratio also we have. Okay, first post-tax cost of debt, which is 16% in case of orange, and reducing tax 35%. So 16 multiplied by 1 minus 0.35 is 10.40 in case of orange, and 8.45 in case of grape, and 9.75 in case of apple. Okay, then for overall cost of capital, first the cost of equity 26% multiplied by 0.2 plus 10.4 multiplied by 0.8, because they have given in percentages, which is 0.8, so obviously the total will be 0.8 plus 0.2 equal to 1, so we don't need to do like divided by 1. Anyway, that will be same. That's a simple logic. Fine. Then grape is 0.5 they told, so 8.22 in case of cost of equity multiplied by the equity portion, which is 0.5, then the rest will be debt, so 0.5 multiplied by 8.45. Same for apple also. So the overall cost of capital in case of orange is 13.52, then in case of grape is 15.225, in case of apple is 17.95. Now the second requirement is economic value added, so which is nothing but NOPAT minus capital charge, wherein capital charge is nothing but invested capital multiplied by weighted average cost of capital, and NOPAT is nothing but the operating income EBIT multiplied by 1 minus tax rate. So it is the post-tax operating income. That's what is net operating profit after tax. And we have found out the overall cost of capital for the three companies, and we know the EBIT. So EBIT minus the tax percentage will give us the NOPAT. Then the invested capital, which is 1 lakh in all the cases, so 1 lakh multiplied by the overall cost of capital will give us the capital charge. Reducing that will give us the economic value added. As we have seen in the previous problems, economic value added is nothing but the extra value which a company is creating over and above its cost of the capital. So when we know the overall cost of capital in case of orange, let's say it is 13.52 multiplied by 1 lakh will give us 13,520. So that is the cost the company is incurring, and how much value it's creating. It's creating around 25,000 minus 35%, which is coming around 16,250. So 16,250. Okay, I'll just write it here. So in case of orange, the NOPAT is 25,000 minus 1 minus 0.35. This is the NOPAT, which is nothing but 16,250, and minus the invested capital multiplied by cost of debt. So 13,520 minus 16,250 is 2,730. So that's what is economic value added in case of Orange. So as we can clearly see here, the operating profit after taxes. So the company is having an operating profit after taxes around 16,250, and the company overall incurring a cost of 13,520 on its invested capital. So the excess value it's creating is around 2,730. That is the economic value added. Yeah. Okay. Now, as we can see, in case of grape it is 1,225, and in case of apple it is negative 1,700. Even though the investment is same in all the cases, and even the operating profit is same in the all cases, but we can see the economic value added is negative in case of apple and it's highest in case of orange. This is because of the debt structure, because as we can see here, in case of orange 80% debt is there, so obviously it will give us a tax shield. It acts as a tax shield, and it gives us a tax benefit on the interest portion, but equity will not give the same to us. So that's why economic value added is more in case of orange, and this clearly indicates that the investor's expectation is more here. The cost of equity is 26%. Considering the debt risk, the investor is expecting a risk premium, because the risk debt percentage is more. These are one of the ways of analyzing the answer. So got it. So the third requirement is, based on the EVA, which company would be considering for best investment? Give reasons. As we can clearly see, Orange company has EVA of 2,730, and if you see the cost of overall cost of capital is also less in case of Orange, which gives another advantage. So obviously, Orange will be considered as the best investment. And worst investment will obviously be Apple, because it's giving a negative EVA. The operating value itself is negative, so it is not suggestible to invest in the company. If the industry, the next requirement is, if the industry PE is 11.x, estimate the price for the share of each company. Okay. Now they are asking to calculate the market price of share, so MPS, which we can calculate by multiplying EPS multiplied by PE ratio, because we know that PE is 11 times the earnings. So we first going with, we know the EBIT, then we know the interest also. Yeah. So interest is 12,800. This is nothing but the one lakh invested capital multiplied by 0.8 will give us the debt portion, so it is nothing but 80,000. Then we know the cost of debt is 16%, which is nothing but 12,800. Same way for grape, 1 lakh multiplied by 50% multiplied by 13% cost of debt. And in case of apple, 20%, so 20,000 multiplied by 15% will give us the interest portion. Now reducing this with the earnings before interest and tax, EPIT, the operating income will give us the taxable income. So taxable income is 12,200 in case of orange, 8,500 in case of grape, and 22,000 in case of apple. Now reducing the tax will give us the net income. This net income is nothing but the accounting profits. So this net income is 7,930 and 12,225 and 14,300 in case of these three companies. Now we know the shares outstanding, and there is no other preference or any kind of equity investment is there. That's what is the assumption here. So whatever shares outstanding, if we divide it, so this net income we are considering is, this is only for the equity shareholders. Dividing it by the shares outstanding, so 6,100 in case of orange, 8,300 in case of grape, and 10,000 in case of apple. Will give us the EPS. So 1.3 in case of orange, 1.45 in case of grape, and then 1.43 in case of apple. Multiplying with the PE ratio 11, 14.3, 15.95 and 15.73. Ideally this PE will not be same, because it usually adjusts for the risk premium, because we have the debt structure in case of these three companies. Fine, let's leave it. I will proceed with the question. So just directly multiply the PE ratio with the EPS, which will give us the stock price or MPS. So that's what they have also given. Since the three entities have different capital structure, they would be exposed to different degrees of financial risk. The PE ratio should therefore be adjusted for the risk factor. But they have not given any such risk factor here. So the adjustment is not required. The fifth requirement is calculate the estimated market capitalization for each of the companies. Now market capitalization we can easily calculate, because we know the MPS market price. Just multiplying it with the shares outstanding will give us the total market capital. So 14.3 multiplied by number of shares in case of, now this is for orange, is 87,230, and in case of grape it is 1,32,385. In case of apple it is 1,57,300. Thank you.